So Jay Powell takes over on Monday. He's taking the reins of the Fed, and he sees a market sell-off one day, a second sell-off which is much more violent. Does it actually change the way that he looks at Fed rate increases?
What's very different this time around is we're seeing far more inflationary pressures building up. So in previous times when the Fed was looking at normalizing rates, if you think back to early 2015, early 2016, any signs of an equity market wobble would really make them take a step back and pause. This time round, I think it's a lot harder for them to do that for two reasons. One is that equities have really exploded over the last year, particularly in January. So all we're seeing is the market taking off the froth. And the second is that we're now beginning to see the inflation mandate send a much clearer signal for the Fed.
Elsa, very importantly, you mentioned earlier the bond idea. Down we go with the bond, price down, yield up. We all know this. Mr. Gross and others have given us great perspective on this. Your concern is a further roll-off in the bond price to a lower price. Bring it up, Jason, if you would, on the wall. This is the 10-year yield. We come down. We've bounced up over on the right side. And the risk is we bounce down. What economic data will get us there? What are you watching, Elsa, to get us there on this key risk determinant?
Well, it's like I said earlier, we're seeing the first signs of inflation really picking up in the US. And, the reason that markets reacted to the jobs data on Friday is because we saw wage growth picking up quite materially. Now, if you look into the detail, and our economists have done that, the wage growth was not actually as widespread as perhaps the headline number would suggest. But that's where we're looking to for signs that this is going to turn into a broader bond sell-off.